Welcome back to Simply Money. Today we're going to be talking about the secrets to smart investing, your path to financial freedom. We're going to be discussing what smart investing is and how to avoid some of the pitfalls people fall into and why they lose so much money in the stock market. We're going to look a little deeper into some things that will help you understand what investing is and how you can achieve financial freedom. The first thing we need to do is understand the basics of investing. What is investing? And we want to look at this and understand that investing is long-term. We're in this for long-term success. You have to understand the difference between investing and saving. Some people are good at saving money, but they haven't invested it, and it's not keeping up with inflation. Check out the video I did here on why it's important to keep up and overcome inflation, especially in times like we're in currently, where inflation is higher than it's been over the last 10 or 15 years. We need to beat inflation, not only to keep our buying power strong, but in order to increase our wealth and build our financial freedom. There are some tools that you can use for investing. We're going to look at what stocks are, stocks versus bonds, maybe look at what ETFs, mutual funds, and even real estate. You have to understand what each of these investments are, how they work, and why they're different. You need to know what your goals are and what you're willing to deal with as far as volatility, what you're willing to put up with as far as having to deal with individuals. If you're going to be into real estate, do you want to do REITs where you're buying into kind of like an ETF for real estate? It's just buying into different properties and you're getting a portion of those profits, just like an ETF does with various companies like Walmart, Home Depot, Lowe's. All of those can be put into one big group and you get a piece of them all. Well, REITs are the same way with real estate. You get a little piece of all the different properties that the REIT owns instead of buying and owning one property. Do you want to own physical property where you have to be the landlord or get a management company to deal with that, to deal with the tenants when the air conditioner goes out? Do you want to deal with that? Do you want to deal with not having renters in, trying to find new renters, marketing? All of those are things you need to consider. We're going to look at stocks, which are basically owning a piece of an individual company. If I own a stock of Amazon, I own a small portion of Amazon, and as it grows, my value in that grows with it. We're going to look at bonds. What's the difference between bonds and stocks? Or bonds are a loan to a company or a government. So you're letting them use your money, just like the bank gives you a loan. In a bond, you're giving the company or the government a loan, and they're more stable in the short term. They're not as volatile. So for some people, it provides stability. They tend to underperform over the long term, though. So you have to understand, am I going to have the risk tolerance and want to get the higher return that I would in the stock market? And they earn money through interest versus a stock. You earn money through the growth of the value of the company and through dividends if it's a dividend paying company. If you're not sure what dividends are, it's basically the company makes profit. They make $100 profit and they want to give 10% of that out. They divide that $10 to all the people that own the stock, and that profit is divided. It's being divided amongst its shareholders. So then you have ETFs, which is a compiling of many stocks into one basket. So you can have 50, 100, 500 stocks, and you get a percentage of each of those, and then you're diversifying through that. And we'll get into that a little bit further. So you can see on the graph the difference between bonds and stocks, and then the stocks will look deeper into how you can compile them in the diversification. One of the big secrets about investing is understanding the power of compound interest. It's been said many times that compound interest is the eighth wonder of the world. It is a powerful tool, and time is its greatest factor. You can put a lot of money in for a short term. You're not going to get the big return that you would if you had long time frames. That's why they say don't try to time the market. Instead, put time in the market. You want to spend as much time in the investment as possible to let compounding work. Let's look at a quick example of how compounding works and why it's so important. Here we have a little chart with two different investors. Investor one, starting at age 25, sets aside $5,000 a year for 10 years and no more investments after age 34. So they have invested $50,000 of their own money. As you can see here in the blue line, they stop investing here. It's growing while they're investing, but it continues to grow. And this is all assuming an 8% interest rate. So we're just comparing apples to apples if they both invested in the same funds, the same process, just to show in comparison. So this person stops investing. So at age 35, they're not making any further investments, but their investment grows to $787,180. That means they have earned $737,000 of interest because they only invested $50,000. See what 10 years difference makes? Investor 2 starts at age 35. They didn't invest anything during this time frame. But at age 35, investor 2 begins to invest the same $5,000 a year, but they have to do it for 30 years. So they are investing $150,000 of their own money, and it grows over the next 30 years to $611,730. You can see the difference of how compounding works. Investor A invested $100,000 less, yet has $176,000 more at age 65, because time is the greatest factor in compounding. In order to let your money truly work for you, you need to give it time to grow. Compound interest is the secret to financial independence. Another important secret is diversification. Don't put all your eggs in one basket. I'm really frustrated right now. There's a YouTuber that I really liked, and I used to follow him. His videos were very educational, and he still puts out some good content. So I'm not dogging everything he does. There's obviously some great input, very educational information. But over the last month, he's got on this NVIDIA trend. When NVIDIA started going up, he got on that saying, look, we need to get in this right before the stock split. We need to buy. You need to buy. It's going to be a great opportunity. And if you recall, a few weeks ago, as of the making of this video, there was one day where the stock market dropped about 3-4%. NVIDIA dropped drastically. The Magnificent Seven stocks, Apple, Amazon, Google, NVIDIA, Tesla, they dropped dramatically that one day. All sorts of news, all sorts of YouTubers were yelling, we're about to hit the recession. This is going to be the worst day since Black Monday and the Great Depression, blah, blah, blah. All this fear mongering that goes on and why people get so emotional in the stock market. And he jumped on that saying, you need to get out of NVIDIA. The ride's over. It had a great run, blah, blah, all this stuff. And then just today, he has a new NVIDIA because the earnings report is about to come out for NVIDIA, and he's saying, you need to buy NVIDIA before because there's so much more upside still. And that bothers me because it's that fear-mongering and why people lose money in the stock market. To buy when it's high, they sell when it's dropping because they're scared, and it just is scary. But if you're diversified, I own NVIDIA, but not as a single stock. It's in some of my ETFs. I'm not big into these up and comings and trying to hit the jackpot. I like to diversify in ETFs like the S&P 500, SPY, something of that nature. I like some good, strong dividend investment to help stabilize and generate income. But I do have some small little pockets of my portfolio just to be in it. It's again a small percentage. But in that, I have NVIDIA. Obviously, in the S&P 500 and SPY, NVIDIA is included in that. So I get to enjoy some of its EPS and its growth potential, but I don't have to worry about when NVIDIA drops if it's the end of my investment. I watched somebody on that channel I was referring to in the comments say, I'm all in on NVIDIA. That's dangerous. You're putting all your hope in one stock in one company, and it may work out. And if it does, you'll hear all about it. You'll hear about, oh, you should have bought NVIDIA when I told you. You watch videos of people saying you should have bought Amazon when I told you, but they also don't show the videos that they said you should have bought all these other companies that you don't even know about because they no longer exist that they told you about. So they cherry pick what they're saying they told you to promote new videos. So diversify and put your investment in ETFs or index funds that have multiple. S&P 500 is a great way to start, especially for new investors. Invest in the top 500 companies in the S&P 500, and the ones that fail will drop out and new ones will take its place to help balance that and keep your portfolio from being so volatile. Diversification, I can't say it enough. I probably said it too much in this video. That is a secret to financial success. Another key secret, I mentioned it briefly a moment ago, is time in the market. You cannot try to get rich quick. Investment is a long-term investment strategy. It is not a get rich quick scheme. It is not day trading. It is not speculating. You're buying and holding. So you need to have a plan. You need to understand what it is you're trying to buy and why you're buying it. So when the markets are down, when the news cycles hit, you're not panicking and you can ride those waves out and spend the time in the market that you need in order to achieve your financial goals. And that brings us to our next secret, is setting clear financial goals. So many people say, I just want to make money. I just want to invest. But you have to understand, what are your goals? Are you trying to save up for a house? Are you trying to save up for your kids' college? Are you trying to save up to retire? What is your time frame? Are you looking at a year, 5 years, 10 years, 30 years? Those should all be factors in how you are investing. When I'm 20, I'm investing much more aggressively because I have time to ride that out. And when I say aggressively, I'm not saying to go buy NVIDIA. I'm saying more aggressive, maybe a higher percentage in a growth index fund instead of an income index fund. Something that is a little less stable, because when we have the big downs, when we have the COVID days, when we have the 2022 days and the market drops, I have plenty of time for that to recover, and not only to regain my gains, but to get more gains. But if I'm in and out in 4 or 5 years, I may not have time to ride out a hard downturn. So I want to be a little bit more conservative and diversify with a greater portion and less volatile index funds than I would if I was waiting 30 years. So set your goals, know your goals. An often underspoken, underdiscussed secret to financial success is risk management and emotional control. If you are an emotional person, and money makes us emotional, we get excited when we see our stock market, when our portfolio, when our investments go up, and we get scared when it drops. If you can't handle and you can't ride out those downturns, you are going to make emotional decisions. You're going to sell when it's down, and you're locking in those losses. You need to stay calm during market volatility and avoid emotional decision making. I highly encourage you to start by reading Psychology of Money. Understand the impact it has and how to overcome your anxieties. I also encourage, if you're highly emotional, to use a financial advisor. Use a fee-only financial advisor that's only charging you when you spend time with them. They're not taking percentage of your assets under management. There's a video I did on what AUMs are and why you need to avoid those, because they're very costly. You could even use a robo-advisor to help you manage your risk. But if you're very volatile, I encourage you to find, if you're married, if you have a partner, work with them to make sure your emotions aren't controlling you and that you're on the same page. If you don't, maybe you have a very close friend that you can use as a sounding board to help ease you when the market is down, or not get overly excited when it's up, to stay the course. So be aware of your risk management and emotional control. Some of the common mistakes you have to avoid is chasing returns. It may be high yield. I saw one today, 93% yield. All that is a yield trap. They think, oh, I'm going to go get this high yield while the stock is just tanking. And you put $10,000 in it, you might get $930 today, but that $10,000 tomorrow is going to be gone. It's going to be wiped out because it's a yield trap. That's an extreme case. But if you're seeing yields above 7-8%, unless it's covered calls that might get 10-11%, you need to be wary of them. You need to stay away from them. Good, strong yields are between 2 and 6-7%, somewhere in there. You might get an outlier here that is strong for a short period, but sustaining yields of above 8-9-10% is very difficult, and you're probably not getting the growth. So you need to look at that. Not diversifying is one of the bigger mistakes that people make, and panic selling. Those are probably your 3 biggest mistakes that you have to avoid. Don't chase returns. Don't listen to oh, look, Nvidia's way up. I'm going to go buy because I'm all excited. I'm greedy, so I'm going to buy. Don't get greedy chasing returns, because that's when you get in trouble. Don't forget to diversify, and don't panic sell. These are some of the secrets to building financial success. I hope you enjoy this. I hope it's been educational for you. And I hope that you'll hit the like and subscribe button. Leave a comment. What is your investing questions that you have? What are some things you'd like to know about? Or give me some input, some things that you disagree with, and we can dialogue. I'm open for that as well. I appreciate you joining me on Simply Money, and we'll see you next time.